And you can click on that link and get registered for that. Next item is the PCC, the FASB's Private Company Council. They've released their 2024 annual report. And as I said, Mike Cheng is here, a member of the PCC, and he's going to talk to us about what's in that report and what's coming up ahead. The PCAOB has released their March 2025 Spotlight Report. So in this report, they report improvements to the deficiency rate among CPA firms that they investigate, a significant drop in the deficiency rate among these firms that are inspected. If you're interested in more information about that, you can download the report from the PCAOB website on that link in the slide. Also want to remind you about a couple of exposure drafts that the AICPA's Auditing Standards Board has issued. These are posted on the website, and they're hoping that they get plenty of comments in, so please consider commenting on these exposure drafts. The first one deals with changes to the literature, the auditing literature concerning external confirmations. Okay, and the comments on that one are due on by June 30th. The changes here, the exposure draft would require external confirmation of cash balances. So we know that that's a common practice among CPA firms, but this change would require it and enhance consistency in auditing practice. It is the standard or the exposure draft recognizes that there are maybe some situations where a firm is unable to externally confirm cash balances, and then there's other procedures that can be performed. It's also a risk-based approach as well. The other exposure draft deals with changes to the attestation standards related to scope limitations in a review engagement. So this one was initiated because of some practice issues when it comes to sustainability reporting and performing a review engagement on those on that sustainability reporting. So the changes in this exposure draft would allow a qualified conclusion and a disclaimer of conclusion on those review engagements under the attestation standards, and comments are due at the end of May on that. Also want to let you know that the Auditing Standards Board has released their strategic plan for the upcoming years, and they're looking for comment on that. So they're laying out what they're proposing to do, and they want feedback from the profession on what you think of all that. So please consider commenting on these items. Okay, and we got one more, I believe, here. Oh yes, last month, if you recall, if you were on our program, we had Jay Schulman join us. Jay is with RSM, and he's also a member of the AICPA's Digital Assets Working Group. And Jay talked to us about stable coins, and it was a really well-received segment on our program. We got a lot of good feedback on it. So if you want more information about stable coins, Jay just joined the Journal of Accountancy and did a podcast with them on stable coins. You can see the QR code there if you want to take a listen to that. He talks about the differences between Bitcoin and stablecoin, why there's AICPA working groups addressing attestation work in this area, and also talks about various resources related to stablecoin. Okay, so that's our news items. Like I said, if you want more information on all those, take a look at the newsletter that will end up in your email box soon after this program. And that takes us to our first segment today, the FASB Private Company Council update with Mike Cheng. Mike, good to see you.
Good to see you.
Yeah, I know this is a very busy time of year, so we do appreciate you being with us today. So I mentioned, Mike, in our news update just a minute ago that the PCC released their 2024 annual report. So how about we start off, I guess, first by can you give us an overview of what the Private Company Council is about? What is their primary mission? And then maybe talk to us about what's in that 2024 annual report. What's the focus areas in there? What are the accomplishments that are listed?
Yeah, sure. And thank you for highlighting that report and providing a very convenient link to access it. So officially, the primary mission of the Private Company Council, or the PCC, is to represent private company stakeholders in the standard setting process for financial reporting. It's no small feat. There's a lot of stakeholders. And to my surprise, when I was reviewing the report, we've engaged with more than 1,000 private company stakeholders through various means of outreach just in the year of 2024. I know when I'm thinking about standard setting and serving my role as a PCC member, I'm personally trying to ensure that users of private company financial statements are getting what they need. And I'm trying my best to have preparers and practitioners focus on areas that users care about and kind of spend less time on what they don't care about. As far as the 2024 annual report, what I'd like to highlight, or at least what is highlighted in the report actually, which is what I'm going to follow, is we've improved our PCC agenda priority process. Jerry Shriver, our new PCC chair in 2024, encouraged us to basically focus on issues that are most pervasive to private companies. And I think it's working. I think we've added and changed quite a bit. If you look at the report that was issued, the 4 projects that they highlight in 2024 is first, to simplify the application of credit losses to current AR and contract assets resulting from revenue transactions, which I think we'll talk about hopefully later. Second, evaluating ways to improve information about contract assets, conditional retainage, and contract liabilities, mostly focused on private companies in the construction industry. And that resulted in a FASB staff educational paper that was issued yesterday. So if you go to www.fasb.org, you should be able to find that paper. Third, started researching and understanding the costs and complexities in accounting for debt amendments. So that's going to be with the same party. But as you'll find out, that has branched off to other areas. And fourth, there was a working group that was established to simplify our favorite accounting topic, what I call leases, or I'm not sure what they're going to find there, but it is a very difficult area, and I know that a lot of people would like it to be easier. And then beyond that, we were obviously actively advising the FASB on projects on their current agenda. I think the most notable is based on our recommendation, so that's the PCC's recommendation. The FASB excluded private companies from disaggregating their income statement expenses, or what we call DICE. I think that that's going to be a very difficult project for public companies to fulfill or to apply. So I think it's only tougher for private companies.
Yeah, I would agree with you there, Mike. And also, I think the PCC has been doing some excellent work for private companies. I follow their meetings, I look at their accomplishments and agendas. So, I just think it's such a great benefit for private company financial reporting to have the PCC in place. And the FASB does listen to the PCC for sure and incorporate many of their suggested changes to the standards. So, you mentioned credit losses, right? And we're going to talk a little more about that, because I know in following the work of the PCC that they've been spending a good amount of time trying to simplify the guidance related to credit losses for private companies, that new current expected credit loss CECL model that companies have been dealing with. So maybe you could spend a little time, Mike, just elaborating on what the challenges are in that area for private companies, what the PCC has proposed in the way of changes, and then hopefully some updates on what's going on with it all.
Yeah, sure. So this project came really quickly. I mean, it was, again, one of the things that we did in 2024, and it's almost wrapped up. So in the beginning, what the PCC and the FASB heard was in applying CECL for at least current AR and contract assets, so current contract assets resulting from 606 or revenue recognition, there really wasn't a material impact on the income statement or the balance sheet. But for most private companies that were applying it didn't change too much, but for some of them, implementing CECL was costly and complex, and most of that complexity was resulting from forecasting what will happen and how that could affect their CECL reserves. And as you know, hopefully if you're reporting under US GAAP and you're making money, you probably have current AR or current contract assets. So this is a very pervasive issue that's consistent with how we're looking at agenda setting. So it was a slam dunk for us to add this to our agenda, and that's what we did. So a lot of this would not have happened, obviously, without the help of the FASB staff. They do a lot of the heavy lifting. And by September of 2024, based on their research, their papers, they were able to ask us a slew of questions and allow us to deliberate and finally issue a proposed accounting standards update. And that was, again, in fall of 2024. By March 6th of 2025, the PCC conducted outreach, digested the feedback on the proposed ASU, and they completed their redeliberations and allowed us to basically recommend to the FASB that they should finalize what we proposed with some minor tweaks. And last week, or March 26th, the FASB endorsed the PCC's recommendation. And a little to my surprise, but I guess I'm not so surprised either, is they expanded this to all entities. So I can only really tell you from the focus of private companies and what this ASU will probably look like, because it has not been issued. I think it's going to be issued in this quarter or Q2. Scope, again, is on current AR and current contract assets resulting from revenue transactions. Based on feedback from the proposed ASU, we did expand this to include current AR and current contract assets acquired in a business combination. It would not make too much sense to only restrict this to stuff that's generated from revenue transactions when a lot of what you carry over in a BizCom is similar. So what is this simplification? So broadly speaking, it's going to allow companies, when they're assessing credit loss, to assume that the current conditions are going to persist throughout the forecasted period. So essentially what you're going to do is for current AR, current contract assets, look at your portfolio, look at what you historically lost, and that's probably going to be the biggest chunk or most of what you're going to do. You now don't have to buy a crystal ball and learn how to be an economist and predict the future. There's also an accounting policy election for private companies, and I think for maybe all companies, I guess I don't know the final standard yet until I see it, that you can consider subsequent collection activity for estimating credit losses. So if you have collected a receivable between the balance sheet date, so after the balance sheet date, but before you make your financial statements available for issuance, you don't have to estimate or reserve for that, but you will disclose, if you do apply this accounting policy election, the date that you've assessed this up to. You also have to disclose that you're applying this practical expedient, but we don't envision that being too difficult. The standard will be effective for fiscal years beginning after December 15, 2025. So for calendar year ends, that's 2026. Early adoption is permitted. Transition is going to be prospective. And for me, at least, and when we're redeliberating this, I wanted to make sure that private companies do not have to assess preferability under Topic 250 upon initial adoption of this practical expedient. So that's the why and what it's supposed to look like, I think.
Yeah, thanks, Mike. That's real comprehensive and very welcome news, I'm sure, for many of the people in our audience right now and private companies out there, and perhaps even beyond private companies. It's just great to hear that you guys focused on those pain points, kind of giving them relief on the forecasting, allowing the subsequent, take a look at subsequent collections. That'll help out a lot of those smaller businesses out there for sure. Okay, so I guess then the last few minutes that we have, let's focus in more now on what's ahead, right? What's ahead in the near future for the PCC's agenda. And also, Mike, when you do that, can you also tell us, because I think our audience would be interested in how does the PCC stay current with the issues that are affecting private companies? How does it keep its agenda relevant, get that feedback so they know what topics to tackle in the future?
Yeah, sure. So I think to that point, I think we have to have consistent outreach. We have to have an ongoing dialogue. We have town hall meetings, as you're familiar with, like Engage. Again, we reached out to, we had touch points with over 1,000 stakeholders in just 2024. Hopefully we continue or increase that. And going into 2025, we now start off with a more structured and focused process on agenda setting. So hopefully that resonates with more of our stakeholders and how we kind of set our agenda and address issues that we think are near and dear to private companies. And a little more just on how we set the agenda. I think the first principle that Jerry kind of made us focus on is pervasiveness, but other things that resonate with me is the feasibility of the solution, our ability to set an appropriate scope. So obviously, even if something is pervasive, but if we don't know if it can work or we can set an appropriate scope, we can sit there and just spend, I think, years or spin our wheels and not come up with a solution. And what's, I guess, close to me or what I care about, right, is, and there's, I guess, subjectivity there, because I focused on the private company decision-making framework as a staff member there. I want to make sure that it's consistent with that. And more importantly, what stakeholders are thinking about today. Going into 2025, hopefully these are issues that you find are helpful for the PCC to focus on. I did talk about, I think, accounting for debt, and more specifically in 2024, the FASB staff conducted research on how modifying debt could potentially be costly and complex. That's kind of branched out. I think if you do watch the meetings, this is kind of a pet peeve area of mine. So I asked them to just look at maybe accounting for, maybe it's too broad, all of debt, right? So starting off first with applying the effective interest rate method under topic 835. That's more specific to debt discounts, premiums, and debt issuance costs. I don't know if we really know how to do that. At least in practice, what I see is people take that amount, divide it evenly over the term, and say that it approximates the effective yield, even though we don't really prove it. I think along the same lines, we will want to continue whether amending debt with the same lender. Could there be areas that we could improve or simplify that? We also considered subjective acceleration clauses or material adverse clauses. We call those SACs or MACs, and how that could affect whether your debt is current or non-current, and debt disclosures. So specific to troubled debt restructuring and debt disclosures, those are topics on the FASB's agenda consultation that they are issuing this year. So we'll wait and see the type of feedback we get for that. I think leasing simplifications with our working group, if we can find any. We will be conducting research on recognizing revenue for short cycle manufacturing. So if that's an area you're not focused, or maybe you haven't heard about, that's basically recognizing revenue over time for customized goods or widgets. And that's a little odd because a lot of people say, shouldn't I recognize it when I guess, transfer control? And that generally seems a little odd when it's over time. And that feedback has come up over and over. I don't know if we can scope that properly, but it has come up. I think weighted average disclosures is something that you'll hear us talk about. Certain areas, it's very, I think, difficult and costly and complex to prepare and audit. So hopefully we can consider some weighted average disclosures that could be removed. At least that's my viewpoint, if users of financial statements don't find them too useful. And we will monitor future public company implementation of DICE, or disaggregation of income statement expenses, before considering a similar project for private companies. To no surprise, I think users of private companies also find that information useful. From my perspective, I'm hoping that they lean a little heavier on their access to management. And again, I started off with outreach. I think we'll conclude too, at least I think based on our discussion here, that we should continue our outreach and dialogue with private company stakeholders. So we're out there and we're listening, and hopefully you feel heard.
Yeah, that's great, Mike. Thanks. Full agenda, and I like some of those topics: the lease simplification, the short-term manufacturing. So you guys got a lot of good stuff to address there. Okay, well, I'll let you go for now, but stick around because at the end of the program, we'll probably have a couple of questions, 1 or 2 questions from the audience for you to take a shot at. All righty. Well, that takes us now to our next segment. I'm going to hand it over to Andrew and Tom to talk about federal funding. Andrew?
Thanks, Bob. So I'd like to welcome our next speaker to the program. Welcome back. Our next speaker to the program has been on a couple times before. Tom Groskopf, who's the technical director and my colleague at the CPEA, and we're going to have a very interesting discussion related to all the financial reporting issues surrounding the federal funding freeze. So Tom, welcome back to the program.
Andrew, it's fantastic to be here, and it was fantastic to co-author that paper in March on this emerging and evolving topic.
Absolutely. So before we get into the nitty-gritty of all the various issues surrounding the federal funding freeze, I think it would be helpful if we kind of provide a background to all of our listening audience. So can you give us an overview of what the federal funding freeze is?
Yeah, well, I think as we're going to couch it in this segment, it started with the OMB action that froze funding that was subsequently unfroze, and then everything else that's happened after that is thrown into the not-for-profit world in particular, a great deal of uncertainty about contracts and grants with the federal government. New assertions, different interpretations, new claims, freezes, as you mentioned. So we're just going to holistically refer to that as federal actions. And so all those federal actions has created a great deal of fluidity. There's litigation, there's disputes. It's very, very factually intensive. It varies dramatically by grantee and nature of the situation with the federal government. So it's kind of hard to avoid speaking in generalities on this, and it is early days. Now, thankfully, I think a lot of not-for-profits are in a time frame in their financial reporting cycle that they've got a little bit of breathing room to sort of digest all of this. So we see a lot of not-for-profits are either calendar year ends or June year ends. So the calendar year ends, this was clearly a non-recognized type 2 subsequent event. At the calendar year end, the Trump administration was not even in place. So while there might be disclosure for non-recognized subsequent events, for a calendar year end, this would not be a recognized subsequent events, at least from our perspective. Now, obviously, the rest of them, maybe more of them, are June year ends, summer year ends, and in that situation, you've got a little bit of breathing space to sort of figure out what's going to happen here. Maybe some of the dust settles. There is some more resolution on some legal matters. Maybe some of these executive orders and other related actions are modified, clarified, et cetera. Nonetheless, we see a lot of not-for-profits modeling out cash flow scenarios, closely examining grants, closely examining contracts with the federal government, and being ready to stress test those against any possible outcomes with the federal government. So I think that maybe gives you a little bit of the lay of the land, obviously highly uncertain. But I think what we did in CPEA, we noted that paper earlier, is really frame this up. It's a long paper, but there's a lot of things to think about.
I think that's very helpful to have that background. So let's dive into the issues. So can you give us an overview of the various issues related to the funding freeze?
Yeah. I think one thing to note that might be helpful for the audience is most of the contracts with the federal government have what's known as a termination for convenience clause. And honestly, when you look at some of the websites, you'll see that that's what they're actually using to terminate these contracts, which says basically, as a legal matter, we can terminate this contract at any time for whatever reason we want. And if that is the case, the federal government has to compensate the counterparty for work performed up to the date of that termination event. So I think that it needs to be recognized at the forefront that there is some level of protection there if there is a termination. Now, in some cases, this may just merely be a delay in payment, and that may have some consequence for aging of receivables, but perhaps that's pretty much it, and perhaps some disclosure if necessary. But in other cases, depending on whether or not the not-for-profit is in the contribution model for the transaction with the federal government, or the revenue model, exchange model 606 in particular, the considerations are different. With respect to transactions that fall into that contribution model, there needs to be potential consideration about whether or not new assertions or claims are an additional, perhaps new condition, a barrier with the right of return. Going back to what I was talking about earlier about not-for-profits, closely examining their grant agreements and contract agreements. We talk about that and things to consider with respect to those stipulations, whether or not they're administrative, trivial, whether or not they do constitute a condition or not. It's a judgment, obviously, but we talk about things to think about in that paper that we wrote. The exchange model, so things like Medicaid, Medicare, et cetera, those transactions are typically much more structured because the accounting guidance is much more structured now after the issuance of 606 and full implementation of it. These actions that I described earlier could cause contract terminations, could cause application of the contract modification guidance in 606, which is very prescriptive, could be considered variable consideration in step 3 of the model as well, where there might need to be updates to amounts recognized and disclosure as well. So it really varies. And as I mentioned earlier, a lot of this is early days, but one of the things that we pride ourselves on in CPEA is our primary focus with national office type resource is private companies and not-for-profits. So we're happy and glad that we were out with this quickly in March, and we will be continuing to follow this. One thing I will add in closing and answering your question, Andrew, we want to hear from folks. I know we got a broad audience listening, and if they do have questions, we want to reserve a little more time than we normally do to get a flavor for what folks are seeing out there about the counterparties to these grants and contracts with the federal government.
Got it. So you mentioned the revenue side of things, and you covered both 606 and contribution revenue, but can you also talk about the receivable side and what NFPs and practitioners should be thinking about?
Well, with respect to contribution and accounting for the contribution, if it is in the contribution side, most of the agreements, grants with the federal government would be considered a conditional contribution, and those are only recognized when barriers have been met. That I was referencing that earlier, that a barrier could be present now, or many not-for-profits are thinking about whether or not there is a new barrier, stipulation related to the purpose of the agreement, in particular because of new assertions by the federal government in some contexts. And again, you only are able to recognize that once barriers have been met, substantially met, I should say, which is a high bar for conditional contributions. The revenue model, as I mentioned, is much more structured. and you walk through the 606 process for recognizing revenue, which again could think you need to think about variable consideration and other things.
Got it. So let's kind of talk about disclosures now. So I know that's probably top of mind for a lot of NFPs and their auditors. So what disclosures should NFP practitioners and NFPs in general be aware of, be looking out for, and are there any sample disclosures available that they can use as reference?
Yeah, I'd cite our report that we wrote for sample disclosures on that. I think I'll speak again first to the calendar year end of not-for-profits, where this was a non-recognized subsequent event that may need to be disclosed, again, as a non-recognized subsequent event. We do provide some examples considering whether or not the financial statement effects are known and considering when they are unknown. Beyond that, getting now to situations with junior ends and thereafter summer year ends, it would obviously be a recognized event. Things to think about with disclosure: nature of operations, risks and uncertainties, liquidity and availability of resource disclosures could be something you may need to think about, not-for-profits in particular. I will point out, because we've gotten this question, that the liquidity and availability of resource disclosures on a quantitative basis needs to be as of the date of the date of the statement of financial position, balance sheet date in the for-profit world. So for a calendar year end, again, that would be non-recognized. So, but again, for summer year ends that are coming up, that very well may affect the liquidity and availability of resource disclosures. Perhaps concentrations as well, that disclosure language there might need to be made, new disclosure language may need to be made there relative to this situation. And finally, for some not-for-profits, going concern disclosures may need to be considered as well if it has that significance of an impact. And it just really stress that if they are following GAAP, that the going concern process is no longer anchored to a balance sheet date or statement of financial position date. It's 1 year from the date of the issuance of the financial statements, not what it used to be, and it is in other financial reporting frameworks where it's 1 year from the balance sheet date. So in that setting, a not-for-profit calendar year end may not be quite as fortunate as they are in other settings for recognition and disclosure.
That's good stuff. All right, so we've got a couple minutes left. So do you have any final parting words for NFP practitioners and auditors? Any final advice for them?
Yeah, stay tuned to what we've been doing in CPEA. I know you and I have had a lot of discussion about that. We are plugged in with a lot of practitioners, the not-for-profit expert panel. We certainly will be continuing to cover this. It obviously continues to be early days, but I think one of the things that's important to me, being part of CPEA, is to really be out in front of these type issues and not doing it reactively. Oh, what do? We have this going on, and the client said this, that. We're out trying to get the report released. No, well, we want to be proactive with this as possible. So stay tuned to what we're doing in CPEA, and please let us know, as I mentioned earlier, what you're hearing about some of the issues that you may be getting from your not-for-profit clients.
Sounds great. And I'm sure we're probably going to get a lot of questions on this topic, so we'd like to bring you back on at the end to cover as many of them as time will allow. So I appreciate your time and look forward to visiting with you in a little bit.
Fantastic.
All right, so that brings us to our final segment of the program. And I'd like to welcome back to the program Debbie Smith, who is the chair of the EBP AQC Executive Committee, and she's going to be visiting with me today about all things employee benefit plan related. So Debbie, welcome back to the program.
Thanks, Andrew. Thanks for having me.
So let's dive right in because I know we have a lot to cover. So when you were on the program last year, you shared with us the results of the DOL audit quality study. So what are some of the things that the AICPA is doing in response to the results of the study?
Yeah, so maybe for those who may not have heard about this study, I'll just spend one quick second here talking about the background on the study. It was issued last year. It was their most recent audit quality study. And in that report, they did find that 70% of the audits did comply with professional standards, but 30% did have some issues with respect to complying with GAS requirements. On a positive note, as the chair of the executive committee of the Quality Center, I would say that member firms of the Quality Center did fare better than non-member firms. But regardless, the audit quality study still tended to find deficiencies in some of the areas that are really unique to employee benefit plans. And those include testing contributions, benefit payments, participant data, and also party and interest and prohibited transactions. So the Quality Center has been involved in many different activities in response to that 2023 study. The first of which is the first bullet here is that there's members of the AICPA that are meeting quarterly with the Department of Labor talking about audit quality matters. Since late remittances continues to be a topic, it's like an old topic that keeps being revisited. Since that continues to be a topic that's on the list, the executive committee has been working with the employee benefit plan expert panel of the AICPA in an area where we've identified that there might be an opportunity to provide some enhanced updates to the audit guide, specifically with respect to the suggested procedures to be performed over the timeliness of contributions and loan repayments to a defined contribution plan. And again, not to make everyone here an employee benefit plan auditor, or maybe you're not even involved in sponsoring a plan, but the Department of Labor does have a definition of what is a plan asset for participant contributions, and it does require that an employer needs to segregate contributions and loan repayments, again, employee deferrals and loan repayments, from its general assets as soon as administratively feasible, but no later than the 15th business day of the month following the end of the month in which the amounts would have been contributed by the employees or withheld from their wages. And this 15th business day is not a safe harbor, that's a maximum. But it's still an area that sponsors do struggle with to some extent, as do the auditors. So what the expert panel is looking to do is basically go to the ASB and see if they support a proposed enhanced update, which would clarify what the auditor's responsibilities would be in testing in this area. They talk about, first of all, when you're making inquiries of the plan sponsor with respect to their compliance with the DOL's regulations over the timeliness of remittance, maybe ask questions. First of all, is it clear that they understand what the DOL's regulations are with respect to this area? What is their policy, and how does that policy line up with what the regulations require? What steps have maybe the sponsor taken with respect to untimely remittances that have been identified? And again, are they even just aware if there's been any untimely remittances for the year? And then based on that, the auditor would say, okay, go through and determine what their risks associated with noncompliance in this particular area. And maybe they're going to request the sponsor to put together some sort of a schedule of remittances that they can take a look at. Maybe they test individual payroll dates, or, one of the areas that commonly there are issues with timeliness are manual paychecks and off-cycle pay runs. So we're just trying to give people some ideas as to where they might look, depending on, again, how responsive the particular employer is with respect to this topic. In addition to that, the AICPA is also issuing or just has issued, I should say, a non-authoritative plan advisory to help plan management understand and apply the DOL's regulations with respect to this topic. So that is available. In addition to that, some of the other audit quality responses are, first of all, we did work with the peer review folks to identify really what are some of the more common misconceptions that maybe be contributing to some of the audit areas that continue to be on the DOL's audit quality list. And again, as I mentioned, some of the top 3 deficient areas are contributions, benefit payments, and participant data. The Quality Center is actually holding a webcast. It's tomorrow, and there's going to be rebroadcasts where they're going to walk through those areas and talk about some of the common misconception and offer strategies for addressing them. And another example would be is that the Quality Center has a number of other existing tools. It has also put together a tool that kind of summarizes by each of those areas what are the tools that are available and links to how to find them. So those are just some of the things that the Quality Center is doing in response to the quality study. So
Excellent. I know you had mentioned the late remittances. That seems to be an issue. I know when I was in practice, that came up, and in peer review, that came up all the time. It seems like that's an issue that Marcus Aaron himself always says during the conferences, that he hopes to, make it through the end of the session without having to talk about it, but it always comes up. So it seems like
it
that's an
always
issue
comes
that's
up.
never going to go away.
In real estate, it's location, location, location. And in a defined contribution plan, it's timeliness, 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 usually in this particular area.
That's right. So
Okay.
let's move on to another topic. So rumor has it that the SEC will soon be requiring plans that file 11Ks to use XBRL. Can you tell us when is that effective and what resources might be available to plan sponsors?
Yeah, I can do that. So first of all, the SEC had these two releases that talked about when the XBRL is going to be required. And for 11K filers, there was a 3-year transition period. So it's going to be required for all 11Ks that are electronic filings on or after July 11th of 2025. What is helpful, though, is that there is a implementation guide that FASB put out. There's a link here. So again, this will be required. When I think about many of the 11Ks that get audited each year, just assuming that they're following the ERISA reporting rules and their calendar year-end plan, most of those are going to be due before the end of June. Sometimes they get extensions for a limited period of time, but make sure they get, if there is an extension, still get it filed before the July 11th date. Otherwise, you're going to be in the bucket of needing to do the XBRL reporting for your 24 financial statements. But what I've also been talking to, Andrew, some clients in our firm is, even though not required for 24, maybe take a practice run, go through and see how this might apply to your 24 financial statements and what the tagging might look like. And again, the implementation guide is very helpful. And also the thing I wanted to mention is for those firms that may be on here that are Audit Quality Center members, we did have an 11K webcast where Melissa Nicholson, she's a supervising XBRL project manager with FASB. She was on there and she spent a good half hour walking through some of the things to think about. So yeah, plan ahead. Not this year, most likely for anybody. It'll be next year.
Got it. All right, we have a couple of minutes left. So I know the EBP conference is coming up next month, but can you kind of mention what training is out there, maybe staff level training and training that might benefit both auditors and plan sponsors related to EBP plans?
Sure. Yeah, again, the May conference is the big national conference. It's in Las Vegas here in the beginning of May. Next year, it's usually around the same time frame. It's actually going to be Florida. So we like to make sure we keep the East and the West parts of the country happy. But the other thing I wanted to mention is that, and this is something that was developed and released last year, but many may not be fully aware of it. We have a foundational program that is basically, it's like 20 modules. They're broken up into bite-sized pieces. It's really just what you kind of need to learn if you're dabbling in this space. And it's audit methodology agnostic. It's really great, just background information for those who are just kind of starting to put their toe in the water in this area. We are using it in our firm for all of our new people to EBP. And then we supplement it then with, how do you conduct an audit using our methodology? So we just want to make people aware of it, that this is out there. And I think it's not only helpful to auditors, but we've also heard plan sponsors who are interested in making that available to some of their people who work in the retirement plan space, as well as some of the third-party administrators out there. So just want to make people aware of it. Again, it's 20 modules. For those who need CPE, it's 10.5 hours of CPE as well. Okay.
Excellent. Well, I appreciate the insight. It's been a very informative discussion, and we'd like to bring you back on here in a couple of minutes for the open forum to answer some audience questions. So,
sure.
And with that, we're going to move right on into the open forum, actually. So I think Bob is going to kick it off with the first question for Mike.
You're correct, Andrew. All righty. So some very interesting conversations there. Plenty of questions have come in. Mike, we'll start with you since you were our first segment. As you can imagine, we received plenty of feedback from the audience members, a lot of positive feedback about the work of PCC, but there are some specific questions. So I'll start off with a couple here, and then we'll move on. So the first one is going to be about leases, right? Always a very popular topic. 842 implementation now going back years, but still very relevant. So in regards to leases, can you think of, are there any items that you can think of that would cause a simple related party operating lease to not be treated as a right of use asset and liability?
Yeah, I guess maybe provide some or a level set. So when you've got a lease, even for a related party lease, it's based on the legally enforceable rights and obligations. I think Tom will support me on that. That's what the standard says. So once you've got that figured out, then you're going to apply that to 842 just like you would any other lease. So you won't have a ROU asset or an official lease liability based on the present value of what you will owe if that is a short-term lease, right? So you assess it and it's 12 months or less, you're going to be okay. Absent that, if the legally enforceable rights and obligations make you conclude that the lease is greater than 12 months, then you should be booking a lease liability and a right of use asset. Sometimes you might impair that right of use asset. So I could see a situation where you're writing that down, but I don't think that's not what this question is getting after.
Yeah. If I recall, Mike, you're speaking this summer at Engage with Tom, right, on the very topic of some lease accounting topics at the big Engage conference. Yeah, in June.
Oh yeah, yep.
Yeah.
Tom is very familiar. I'm sure he might even correct me when he comes back on. He knows a lot about lease accounting. And Andrew.
He'll have an opportunity in a minute. One more for you then, Mike, and we'll move on to Andrew and Tom. So does the PCC credit losses election apply to loan receivables as well?
Okay, so I guess I'll be clear. The scope is to AR and contract assets that are current in nature that result from a revenue transaction. So I guess if you call it a receivable and it's collectible in 11 months, I think it would apply if you account that as current AR. But let's say you had a transaction, netted $1 million by selling something, but it's payable over 5 years. I think that's what this question is getting after. That is not going to be applicable under the practical expedient. So you cannot just say, let's look at historical past practice. You will have to consider the future and not assume that current conditions will persist throughout the forecast.
Great. Okay. If we have time, we can come back to you for another question, Mike. But for now, why don't we move on to Andrew and Tom and see what they got?
Thanks, Bob. All right, so I got a couple questions for Tom. So the first one, this is related to the funding freeze. Would these changes, implications, and disclosures that we discussed previously apply to subrecipients who receive pass-through money? So, for example, this entity gets $20 million in local grant funds, but some of that, let's say $1 million, is passed through from the federal government.
Yeah, it certainly could. Again, it's hard to be specific given the blizzard of actions and the magnitude of money that goes out with these grants, but subrecipient compliance with a lot of things, it has always been required, depending on the nature of the grant or award. And I think the other question that I could kind of just wrap into one is give us some examples of these assertions or claims or whatever. Again, given the wide swath of actions, it's hard to be too specific, but I know one area we see a lot of not-for-profits thinking about it at a minimum is what's the new thought about qualifying expenses? Said differently, are certain things no longer considered qualifying expenses because of executive order, whatever? That's something a lot of them are thinking about. and that could constitute a new condition, or at least a review of the current grant or contract that might give some rethinking about what is a condition that may not have been in the past. And it just is a little bonus for Mike, and I am looking forward to our Engage session in June. Great answer. I just would add the written terms and conditions, practical expedient, could be used instead of using or trying to define what the legally enforceable terms and conditions are for a related party lease. And in that situation, assuming it's common control, you can pretty much do whatever you want. And as Mike always points out, you could also make a lease entirely variable payments, and that would be off balance sheet as well. So there's a lot of different ways to get the answer that I think the questioner was looking for. It just takes some accounting creativity and insight.
Excellent. Well, I appreciate the insights as always. And now I'd like to bring Debbie back on for a question.
Sure.
All right, excellent. So I know when we were going through our discussion, we didn't get to a few topics I think are very important. So could you comment on other items and topics that the EVP expert panel is currently focused on?
Sure, Andrew, and I'll just cover two of them really quickly here. First of all, it's CECL. Obviously, we've been talking about CECL a fair amount on today's webcast here, and Mike discussed earlier the proposed credit loss to ASU and how it impacts certain private companies and not-for-profits. Please know, though, that employee benefit plans are excluded from the scope of that proposed ASU. So we are going to be working with FINREC to submit a comment letter as part of their invitation to comment regarding whether or not that the practical expedient in accounting policy election should be expanded to short-term assets such as certain employee benefit plan contributions receivable. In addition to that, we might be submitting just a FASB agenda scope plans out of CECL in its entirety. And the other thing was, there's been a lot of discussion in the last month about group audits and the applicability to plans, and how 149 kind of changed the focus of what triggers whether you're in or out of that standard. So there's been a lot of wrestling among the different expert panel members talking about, what is the definition of a consolidation process, and are there certain plan scenarios when the group audit standard might apply, or is there perhaps, as written, maybe some unintended consequences? There's some interpretations that need to be had here. So actually next week, there are certain members of the expert panel and AICPA staff. They're going to be meeting with the AITF to confirm some of the conclusions that have been reached, and maybe getting some clarity on some of the areas where a conclusion couldn't be reached. So more to come.
Excellent. So we'll stay tuned for further updates.
Yes.
All right. Well, I appreciate it. And now I think we're going to move into the wrap-up portion of our program. So I'd like to turn it back over to Bob to close us out.
Yes, sir. Thank you, Andrew. And thank you, Debbie. Okay, well, hope you enjoyed our segments for today. Certainly, if you want to hear more about the employee benefit plan sector, we've got that conference coming up in May. If you want to hear more about leases, Tom and Mike are about the two biggest experts I know of on that topic, and they'll be talking about that at our Engage conference in June. Our next ANA Focus webcast is on May 7th, okay? If you already registered for these webcasts, you don't need to re-register for the next one. You are automatically registered for upcoming ANA Focus webcasts. Again, the next one on May 7th. Keep an eye open for the newsletter that will be coming out into your inbox after this webcast as well. Please remember to fill out the surveys, okay? Give us a rating, give us your review of the program, and most importantly, give us an idea of what you want us to talk about. What topics would you like us to cover? We do look at that all the time and plan our future webcasts based on that input. On our upcoming May 7th webcast, we've got some excellent guests again. Mark Koziol, the new CEO of the AICPA, will be joining us, and he'll be talking to us about the AICPA and his plans for the profession and the organization. With us is Angela Newell. Angela, Deputy Managing Director at BDO. She has been joining our webcast for a while now, talking about revenue recognition accounting and going over all the 5 steps in FASB ASC 606, and she's back to talk about the last step, step 5. And then we're going to have Renee Rampula on board. She's the managing member and founder of Rampula Advisory Services, and she will be talking to us about quality management standards. CPA firms are engaged in implementing these new quality management standards. It's a big deal for firms this year, and we want to make sure we cover that topic. And Renee's going to do a great job for us on them. For future dates through the summer and the rest of the year, take a look at these if you want them for your calendar. As I said, you are automatically registered for these webcasts as well. Okay, well, I want to thank our guests, Mike and Tom and Debbie, for their great presentations. Thank you to Andrew, my co-host, to our great multimedia team and our producer, James. And thank you for attending today and being members of the AICPA. And we'll see you next month.
Thank you for joining us. Be sure to visit ANA Focus on AICPA-SEMA.com for a recap of today's event and a wealth of timely AICPA member resources. SEMA.com for a recap of today's event and a wealth of timely AICPA member resources. SEMA.com for a recap of today's event and a wealth of timely AICPA member resources.